All right, up to this point in class, think about what we've done. We started first with conducting macroeconomic analysis. We tried to get a forecast for what the economy is going to do. We talked about monetary policy and fiscal policy and how those policies might affect economic activity. Next, we talked about industries and we explained how to go about conducting industry analysis. And then more recently, what we did is we learned about how to price bonds and price stocks and maybe what to look for when pricing bonds and stocks uh, when we're looking to invest in those things. All right. So obviously, forecasting the economy, examining how it affects particular industries, and then picking stocks to put in a portfolio is probably hard enough. We're going to make it slightly harder now. So what I'm going to do is I'm going to introduce the idea of an optimal portfolio. Hopefully you've watched the previous videos in this section and you've understood what the Markowitz efficient frontier is. But what we're trying to do when we talk about optimal portfolios, we're trying to talk about the optimal allocation of your wealth in the various assets that you've selected to put into your portfolio. All right. So here is somebody's suggestion. I don't agree with it, but whatever. Uh, anyway, so this particular person says of the 100% of your pie, of the wealth that you have, you should put 18% in U.S. stocks. VTI is a Vanguard Total Market Index. You should put 28% in foreign stocks, 32% in foreign bonds, and 22% in U.S. bonds. All right. And within these U.S. stocks, this individual is suggesting just buy an index fund. You might select individual stocks for your portfolio. All right. And so what an optimal portfolio is trying to tell you is how much of your wealth should you put in each of the individual assets. All right. This is similar to a previous video that we've been discussing. Suppose you have two assets that you want to put into your portfolio. You have asset A and asset B. Asset A has this much risk and this much return. Asset B has this much risk and this much return. This is what you expect, of course. All right. And what we're going to do is we're going to talk about how much of your wealth you should put in asset B versus how much of your wealth you should put in asset A. Now notice you can put 100%, you can create an infinite number of portfolios just with these two assets. You can put 100% of your wealth in A, 0 in B, or 100% in B and 0% of your wealth in A. You could put 99.9% of your wealth in A and 0.1% of your wealth in B, and so on. You can create an infinite number. All right. In a previous video, we talked about the possibility of what happens if you put 50% of your wealth in A and 50% of your wealth in B. If I were to tell you this individual put 50% of their wealth in A and 50% in B, you would think that the portfolio would be just right here in the middle, halfway in between A and B. But because of covariance, which we discussed in the previous one of the previous videos, because of covariance, that's not true. What happens is the covariance structure will allow you to bend off of this line. For instance, I can create a line between A and B that begins to bend off that line. Does that make sense? Now notice something. I want to be up here in the high expected return and low level of risk quadrant, right? This is where I want to be. And what happens is that as the covariance between asset A and asset B becomes more negative, we begin to bend off this line. All right? So much so that let's suppose that this is the frontier that we can get. This is the Markowitz efficient frontier. All right. And we can create a number of portfolios anywhere on this frontier and inside this frontier, but we can't produce portfolios outside of this frontier. All right. The question becomes what portfolio should I select? What weight should I select in asset A and what weight should I select in asset B? The idea here is the optimal portfolio is to select the portfolio that is in the most northwest quadrant on this efficient frontier. I'm going to say that it's, let's say you can produce a portfolio that exists right here. Okay. Let's call that portfolio P. you would want to select this portfolio P, which might tell you to put in 30% of your wealth in asset A and 70% of your wealth of asset B. That might be the optimal portfolio, the portfolio that gets you to this quadrant, that gets you in the most northwest quadrant, that gets you the highest expected return for the lowest level of risk. All right. So when we talk about optimal portfolios, what we're talking about is allocating our wealth into the assets in our portfolios optimally, trying to get to that northwest quadrant or trying to get to the highest expected return for a given level of risk. It's important to note something here. I could draw another, I might be able to obtain another portfolio on the efficient frontier right here. Okay, we can call this portfolio R. All right, and notice that portfolio R on the efficient frontier doesn't get you into the most northwest quadrant, but does get you the lowest level of risk. All right, so we would call portfolio R here the portfolio that gets you the lowest standard deviation for your portfolio. Okay, the minimum standard deviation portfolio is portfolio R. The optimal portfolio is portfolio P. Of course, preferences of investors depend on which portfolio they would prefer. What we're going to do in the next little section of class is we're going to figure out how to find those portfolios for multiple assets. Right?